real estate finance, distressed property, non-foreclosures. So the main non-foreclosure avenues in this class are going to be loan modifications, deed in lieu, and short sale. So a loan modification, that's an agreement between the lender and the borrower to change the terms of the loan. So some types of loan modifications are HAMP, which is a home affordable modification program. The goal of that is to lower the monthly mortgage payment to 31% of monthly income. So this is done by either reducing the interest rate, extending the term of the loan to 40 years, or deferring a portion of the principal to the end of the loan. So the borrower might be eligible for loan modification if they experience a hardship like a cut in work hours or illness that prevent them from working. It is important to note that you must have some income to modify a loan. So a job, like a job loss or a complete loss of income is usually not going to be grounds to modify a loan. Forbearance, see above, we talked about that in the last video. For deferment, that's when that's when the lender takes the missed payments and puts them at the back of the loan. So it adds time to the loan term, and you pay those missed payments at the end of the loan term. Next, we have a deed in lieu of foreclosure, also called a DIL or deed in lieu. That eliminates, there's not going to be a public record of the foreclosure. Also, it allows the borrower to rebuild credit sooner rather than having a lengthy foreclosure that will continue, to report on your credit report. The bank usually won't seek a deficiency if the borrower agrees to a DIL. Sometimes, rarely though, a bank will pay the borrower to agree to a deed in lieu because it's worth $1,000 payoff to the bank to avoid all the time and expenses of foreclosure. A bank might refuse a DIL if the property is underwater. The bank thinks this is a limited hardship, like just temporary reason, drop in income for the borrower. Maybe the bank doesn't want to sell the house, or there might be a huge liability, like there might be a huge environmental cleanup cost if the bank gets the property. And if the bank takes the property back, the borrower could claim the property to the bank, but there's still other liens encumbering the title. This was bank foreclosure problem. So for short sale, this happens when you sell the property for less than the mortgage. The idea is that the lender agrees to release the mortgage at a loss. The benefit for the bank of a short sale is that they don't have to manage or sell or a property that is underwater. The benefit for the buyer is that they can keep their home until the property is sold. Also, they can avoid a foreclosure on their credit report. But keep in mind that forgiven debt, like here, deficiency that's forgiven, that's going to be income. So any forgiven debt by the bank is a taxable event, and the borrower might have a tax liability to the IRS on the forgiven debt.